by the way, at the bottom of your screen. We've got EBITDA profits which have come in at 1942 crores. This is significantly higher than what the expectation was, which was 1,833 crores. Margins, I think, are coming in below, a little over 100 basis points below what the expectation is, 9.5 compared to what the expected 10.6. The net profit there, and I think we have the revenues coming through as well. 23,458. This is bang in line at 23 as compared to 23,655 odd crores. So I think broadly these are numbers. Margins seem to be a little lower than what the expectation was, but otherwise, I mean, I think the numbers are just about okay. So 79.10 on Maruti. It's still in the green, still not reacted to the numbers. But I think our colleague Sonia is already joining in with more perspective on what she makes of it. Sonia, over to you.
Well, thanks a lot for that, Prashant. So, on the revenue front, at 23,458 crores, it is slightly lower than what the street was estimating. We were expecting about 23,655 crores. So, it's still a double-digit growth that we're seeing, but about a 12% growth on a year-on-year basis. The margins are actually slightly under pressure, 9.5% versus a poll of 10.6% and versus 10.2% that the company saw same time last year. So, both on a year-on-year basis as well as compared to the poll, the margins are slightly lower than what the street was estimating. And if you look at it, the last 6-quarter performance, the margins in Q2 were about 10.3%. So compared to Q2 as well, the margins have fallen. In Q4, they had about 8.5% margin. So compared to that, it's a rise. But this time around, because raw material cost pressures have been high, the gross margins were also expected to be under pressure. Now, realizations have also fallen about 1.5% year-on-year for Maruti this time. That's because of the higher number of entry-level and mid-level cars that they have sold. So the product mix has weakened a tad bit. Raw material costs have been higher, and on account of that, the margins are slightly lower than what the street was estimating. Also, the stock is not cheap. It has priced in the world. I mean, if you look at it, the stock currently trades at 30 times FY22 PE compared to its own historic average multiples of around 22 times. So there is really no room for error as far as Maruti is concerned, and that's perhaps one of the reasons why you could see some profit taking as well. But for now, I'll have to say on the revenue front, not too much of a disappointment. We of course know the numbers, so it is a 12% growth that we're seeing. Just that on the margin front, compared to both year-on-year, quarter-on-quarter and the poll, the margins are lower than what the street was estimating.
Absolutely, Sonia. In fact, the management in its own presentation says that the negative factors for margin compression is adverse commodity prices, unfavorable product mix, and also adverse foreign exchange fluctuations. So material cost has gone up 180 basis points on a year-on-year basis. But hold on, Sonia, we also have Aditya Makharia, Senior Analyst at HDFC Securities, joining us now on the phone line. And we also have Naveen Kulkarni of Axis Securities, who is also joining us. Gentlemen, good afternoon. Thank you so much for joining us. You heard Sonia detailing what went wrong with the numbers this time around. It was a margin miss. However, revenues are largely in line with estimates. What is your take on the numbers? And do you think that come in Q4, these numbers are set to improve from current levels? Naveen, let me come across to you first.
As far as the margins are concerned, the margins are in line with our estimates per se. But of course, the street would be slightly disappointed because the street was expecting the numbers to be better. As the management has detailed out, the product mix as well as the raw material conditions have been the key challenges. So I would say that the market will be disappointed and the stock could correct from current levels considering the positioning that has happened in the stock. Going forward, I believe Q4, the raw material cost inflation would of course be higher than what it was in Q3. So that will also have an impact on Q4 numbers. I do not know whether there will be a significant improvement in product mix, but probably product discounts might reduce. Overall, I feel Q4 numbers or especially the margins may not actually surprise positively. So I think the pressure on margins is more likely to continue. So we'll wait and watch for that from here.
Okay, so the pressure on margins could continue. Just a couple of more internals from the presentation itself. the raw material cost as a percentage of sales has gone up 180 basis points. So that's where the key pressure point is coming in from. Now raw material costs stand at 76.4% as a percentage of sales compared to 74.6% same time last year. Other costs have actually come down. Employee costs have come down as a percentage of sale. Other expenses is down. It's just that the raw material cost is really something that's hit the margins this time around. And the management has said that not only adverse commodity prices, but the unfavorable product mix. As I was saying, they're now selling larger number of entry-level and smaller cars. So that has sort of diluted their margins a bit. Aditya Makharia is also with us. By the way, the realizations per unit at 4.73 lakh per unit is not bad. It's actually higher than what the street was estimating. So realizations are fine. But Aditya, how would you react to these 9.5% margins? I mean, our poll threw up about 10.6%. But would you be disappointed, or do you think that this raw material cost pressures can be passed on to consumers, and the company can perhaps recover margins as well? I mean, what is your own analysis?
Sure, Sonia. Yes, we were expecting margins to be at slightly higher than 10%. So to that extent, they have come in lower than what we were building in. And while that would be a near-term slight miss, the point I would like to highlight is next year we are looking at a recovery, across the economy. We are looking at a GDP growth. Estimates vary between 7% to 10%. In that backdrop, we expect volume growth for Maruti to come in double digits in, FY22. And we hope that as the product mix normalizes, once people are back to their normal patterns of consumption, we should see some offsets which the company can have on the margin. So the margin levers for them should improve going into next year. Of course, commodity is the key monitorable, and it's the joker in the pack. But from a demand standpoint, things are looking good. From discounting angle, that remains well under check. So we do hope the company can, deploy more of their cost-cutting initiatives and hopefully make up for some of the commodity pressures which we are seeing.
Okay, actually it only seems to be a material cost issue, because all the other costs have actually come down for the company year on year as well as quarter on quarter. So material costs, even quarter on quarter, they've given the breakup. It has gone up 240 basis points. So between Q2 and Q3, as a percentage of sales, material cost is up 240 basis points. So Aditya, what do you do with the stock now? Because as I was mentioning, compared to its own historic multiples of 22 times, the stock is quite expensive, trading at 30 times forward. Do you think it could correct from here? Would you be cautious, or would you use every dip as a buying opportunity in Maruti?
Sonia, we've highlighted this before, that we are in the recovery phase, and whenever you look at valuations which are in the recovery phase, they do trade at premium to what the standard or the mean PE has been. So Maruti is somewhere around 1 standard deviation above the mean, and that is true for most of the auto stocks. I think like I mentioned, as the volume growth comes in double digits, so the valuations, if we trend to FY22 and now investors are looking more at FY23, the P multiples actually look much lower than what they are. And to that extent, on the valuation side, we believe if the volume growth does continue to remain in double digits, investors will look through the near-term price movement, and they will focus on the medium picture, which is certainly improving in our view.
All right. We have Mitul Shah, who also joins in now. Mitul, your thoughts on Maruti's numbers? Apart from the margin disappointment, everything else looks pretty stable. I mean, it's a profit growth of almost 24%. And the management's commentary as well, they do say that the capacity utilization has improved. Sales promotion expenses are lower. There are cost reduction efforts. Do you think the stock could sort of bounce back despite the weakness that we've seen in margins?
See, I would look at 2-3 parameters which I feel is a very medium-term parameters. One is a product mix, which is an entry-level car sales is higher. As we all know, during the pandemic, people has some constraint on the budget. So going forward, as the situation normalizes and industry will move to double-digit growth, people will again go back to premium products. That would also help on the margins front. Secondly, as you pointed out rightly, only raw material is the biggest issue. And if you look back to 2008, whenever any such recession or such a sharp slowdown happens and recovery starts, initial impact is a very sharp jump in the commodity prices, but that also stabilizes after 1 or 2 quarters and that comes down. And by that time, company also gain the pricing power to pass on this cost escalation. So we believe that company already took some price hike that will happen again in the coming quarters. So maybe after 1 or 2 quarters, complete cost escalation will be passed on to the end customer. So that issue will be also addressed by the company. And third thing is that as earlier communicated, double-digit growth is expected for FY20 as well as FY23 also. So there is a probability the margin improvement street will start upgrading their earnings for FY23 and 23 earnings stock may not look very expensive. So its valuation will continue and stock will continue to trade at higher, maybe near term some pressure, maybe there for the stock, but we remain positive. Structural basis companies seem to be very strong.
Okay, all right. So that's 2 analysts out of 3 telling us that despite the slight bit of margin hit, the structural uptrend for Maruti will continue. There is double-digit growth that we're seeing in volumes. And even if you look at the revenue trend, I think the graph will come up for you in a bit. At 23,458 crores, this is the highest revenue that the company is seeing at least in the last 8 quarters. So an 8-quarter trend is what we have. On an average, the company has done revenues between 19 and 20,000 crores in the last 8 quarters. And now the revenues have risen to 23,458 crores. So definitely the company is selling more products. It's just that the product mix has weakened. So in this post-COVID era, people prefer to buy perhaps, smaller entry-level cars. So the product mix has weakened a bit. Prakash Diwan, quick thoughts from your end too. Would you agree with the other 2 analysts that despite the slight weakness in margins, the stock is a buy and the earnings could, sort of pick up as the consumption trend continues?
So Sonia, since a lot has been discussed on the metrics on the earnings, I just want to point out the biggest worry is not the cost escalation. That would actually they'll be able to pass it on, and as volumes grow, it becomes much easier to do that. The worry is this product mix. They've not had a single, and it's not that the competition is not growing. You look at how the Tata vehicles are selling on the premium side. You look at how the Kia has taken up share. You see the Cretas of the world getting into that premium side. I think after the Ciaz and the Brezza, they've not had a significant product launch to plug the gap. My hopes are on the Jimny middle of this year. If they launch that could probably do what the Swift did for them a few years back in terms of reviving their realization and the entire margin trajectory. So we'll wait for that. If that happens, the company definitely is on its way to getting re-rated upwards. But till then, I think it will probably be sideways on the stock as well, consolidate, and people will want to see the actual improvement in the margin profile for the next 2 quarters.
Okay, all right, gentlemen, thank you so much for joining us. Sonia, thank you so much for joining us, taking us through the numbers and making sense of what Maruti numbers looked like. So it was a margin miss. The stock also is off the highs, down around 1.5% as we speak at the day's low. But let's do one thing. We'll take a quick break. But before we do that, here's